more with what's happening to the emerging market pack. Global factors like oil, central bank policies and trade tensions are dictating market movement in the emerging markets like India too. Brokerages, in fact, have started advising caution given the accelerated outflow of funds. The last 10 days, I've noted at least 5 or 6 key global voices from the sell side come out with their notes of caution on the emerging market due to a variety of reasons, and which is why what we're doing today is not essentially maybe advising caution, but just putting out a summary of what some of the 2 or 3 notes had to say, something that stood out for me. I'm sure there are a lot of other things that other people would speak about as well, but here's what stood out for me on the emerging market pack. Morgan Stanley yesterday, Jonathan Garner and some of his colleagues came out with this note. They are saying that they have cut index targets due to macro pressures, and they see significant downside risks. The downside risks to almost all of the emerging markets. Hang Seng is particularly at risk. Now, remember, in this note, nowhere they have mentioned about India specifically, but they mentioned about emerging markets in general, and they see downside risk to almost all the other emerging markets. Now, why is this important? I'm borrowing something that Bank of America Merrill Lynch has put out 2 days ago with regards to India and the emerging market pack. Now, of course, they are saying that MSCI India's forward PE has normally moved in line with the MSCI EM and the growth differentials between the two markets notwithstanding. Now look at this chart. This is MSCI India and MSCI EM from June 2003 all the way to February 2018. And if you see this forward P, it's hardly shown any kind of deviation from MSCI EM. Now, which is the point that BofA is trying to make, that while we may argue that India is looking fairly robust, the growth differential is great, somehow the forward P doesn't tend to deviate too much from the MSCI EMPE. The next chart that BofA has put out on their note again is that India has underperformed from emerging markets since mid-2015, and the decoupling has never been too exaggerated except for this particular period. So if you look at a particular period from the dates that they are giving, which is late 2013 to early 2015, there has been a bit of decoupling, but otherwise the correlation has largely been in line with what the EMs do. So if the EMs were to fall despite very strong growth prospects, India may not necessarily decouple and stand out on its own. I know this time around it looks to be different because the domestic flows are much more robust than what things have been in the past, but this is only looking at anecdotal evidence to suggest that if the EMs were to fall, India may not be spared. Now, what could lead to this? It's a chicken and egg situation. Do flows lead the markets or do the markets lead the flows? Now, Citi has come out with a fairly interesting note. They are talking about how there is a significant risk for the EMs because of the fund flows. They are saying that outflows can deepen the existing trend. They are unequivocal in their view that flows are following the fundamentals in the market trend. And because the existing trend, according to them, is on the downside, they believe that outflows, which we may well see going ahead, would only deepen the existing trend. They expect more post the weak 2018 performance. Because 2018 has been so lackluster for EMs, they believe that flows could only heighten, or outflows could only heighten going ahead. More so because flows until now, according to them, haven't really been dramatically large. EMs, according to them, haven't seen dramatically large flows, outflows that is. It's been muted to an extent, and they have a chart which is suggesting this as well. And then, this is the local and the hard currency flows, and just look at what they are trying to point from Jan 2004 onwards until Jan 2018. Look at these peaks that the local flows and the hard flows are typically from the stronger economies, but the local flows and hard flows, there are peaks that were reached, and now we are no longer at the peak, which seems to suggest that flows haven't been dramatically large from EMs by and large. There have been past instances wherein outflows have been much more stronger. And why do I draw the India inference? I take on board the Morningstar data that recently has come out and that they've put out. Not that this is not available anywhere else, but they've put it succinctly, and therefore I put it out. Look at the net flows. We've been talking about how FIs have been shunning India. But hey, I mean, if you just look at what's happened Jan onwards, there have been 2 months and the month of June as well, wherein there have been positive flows. Net flows have been positive. Yes, there have been outflows in May, there were outflows in April, but net while India has seen outflows, yes, there have not been dramatic outflows from the country thus far, YTD. So Whether the outflows continue for the EMs by and large, and if that happens, the impact or the collateral damage on India, will that happen or no? I think most global brokerages believe that there will be a percolation effect into all of the emerging markets, and India may not necessarily be spared as well. So that's something that we need to watch out for. Flows till now have been, well, muted, outflows that is. Let's hope they do not get exaggerated, though most people believe that they will.